Morning, everyone, and welcome to our webinar. Our topic today is solo 401k versus self-directed IRA, a guide for passive investors. My name is Natalie with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. Our speaker today is Brett Synicky, and I'd like to just briefly introduce him. Brett is a solo 401k consultant here at Sense Financial, and he has a professional journey spanning over 18 years in real estate investing. He's not only a seasoned professional, but also a licensed California real estate agent who is dedicated in facilitating seamless transactions for individuals in the pursuit of finding or selling their dream homes. His passion lies in empowering professionals to attain financial independence and affording them the possibility of an early retirement. He's also a great advocate for financial success and a guiding force in the realm of real estate. So, welcome, Brett, and thank you for the time for taking the time to present today.
Yes, thank you, Natalie. Can you hear me okay?
Yep, sounds good.
All right, thanks for that intro. I appreciate it. Forgot to change slides to this one while you were introing me, but that's okay. There I am. Phone number and email. If you guys want to jot that down real quick, that's fine. It'll be at the end too. But yes, thank you all for joining us today. We appreciate you taking the time out of your precious day. Time is finite, and we don't take that for granted. So I want to make this as educational and valuable as I possibly can during this time. So please, please, please post any questions you have in the chat. You can save them for the end or do it along the way. Either way, we will we should be able to get to all of them. We usually can. And if not, we'll circle back around with you after. Our mission, before I get into this, is helping clients obtain control of and protect their retirement accounts. Proverbs 21:5 says, good planning and hard work lead to prosperity. And that is certainly true. And we know that you work hard for your money and all of your blessings that you have in your life. You work hard for it. And we want to come alongside you and work hard right alongside you and help you do exactly what our mission statement says there. So before we get into this, I just want to briefly talk about what a conventional versus a self-directed accounts look like. Okay, so on the left, you have the conventional side of things, which are controlled by a custodian that only allow investments in stocks, bonds, and mutual funds. Think Fidelity, T. Rowe Price, Vanguard, those types of companies we've all heard of. And then on the other side, we have the self-directed side. So in that side, you actually control the investments. So you get to direct the money into just some examples here: residential real estate, tax liens, options, notes, trust deeds. You can invest in private businesses. You can do private lending. That's actually probably one of our clients' most favorite, if we did a poll, way to make money is through private lending to real estate investors primarily. And then you can also invest in stocks, bonds, and mutual funds. This is not an exhaustive list by any stretch. The IRS does not say what you can invest in. They just say what you can't invest in. And it's a very limited list, which I'll get into towards the end. So the self-directed options we offer, well, some of these we offer, some of them we don't, and I'll talk more about that. We have the self-directed IRA, which is in this case a custodial IRA. Then you have the checkbook IRA, or also known as an IRA LLC. And then you also have the self-directed solo 401k. And you can see right there, we call that the ultimate retirement plan because to us it is. And we'll talk through all the requirements for eligibility, but the solo 401k is definitely superior to the first two options for a lot of reasons, which again, we'll get into. So what is a self-directed IRA? Well, it's a tax-deferred trust account. It is held with an IRS approved custodian, must have a custodian with an IRA, all types of IRAs. And they allow you to invest in non-traditional assets. I listed some of them a couple slides ago. It was actually created in 1974, so it's not new. And this question, why is self-directed IRA little known? It really, you could ask the same question about the checkbook IRA, which is lesser known, and then of course the solo 401k, which is probably even lesser known. Well, it's simply because a lot of financial advisors and those types of professionals who give us financial advice, oftentimes they make money on us investing directly with them. Call it asset-based fees, whatever you want. They don't directly benefit from introducing their clients to a self-directed IRA or a solo 401k for that matter. And the fact is, a lot of them don't even know about it. Maybe they heard of it, but they don't know the inner workings of it. In fact, a lot of CPAs don't, but that's a whole nother conversation. So and this has been benefiting American Savings for Retirement under Internal Revenue Code Section 408. So what are the benefits of it? Well, I already mentioned non-traditional assets, and they do actually provide this can provide true diversification. Okay. So if you invest traditionally, on the conventional side we showed earlier, stocks, bonds, mutual funds, you can kind of be diversified, right? You can have investments in different companies in different sectors of the economy. Maybe you have, the S&P 500 or the Vanguard 100, different mutual funds that cover different, 500 of the strongest quote unquote companies in the US. You could have international stocks and bonds, whatever. Are you diversified? Maybe a little bit. But the fact of the matter is that normally when the stock market goes down, the whole stock market goes down. And I'm not here to poo-poo traditional investing in stocks, bonds, and mutual funds. That I think that's part of the diversification. Okay, but if you're only there, I think potentially you could be at some risk. So investment returns are tax deferred. That's another benefit. There's no capital gains taxes on the sale of real estate, which is amazing. And then you get to leverage your funds. If you want, you can actually get a loan to buy rental property, residential real estate, but it has to be non-recourse. More on non-recourse here in a bit. So how does a self-directed IRA work? Well, you first need to open a new account with an IRS approved custodian. Okay. And then what you would do is you would start a qualified transfer from another qualified account, an IRA, a 401k, 403b, and then you transfer that money to the IRS approved custodian. Then you're that little guy on the left there, you get to direct the custodian. Okay. But everything has to be done through the custodian. And there's fees involved. There's time involved. We'll talk more about that. But all the fees, all the income and all the expenses on the investments. So if you have an example is a piece of real estate, you have to pay property taxes. You have to pay, maybe you pay some of the utilities, whatever, property management, all the income, the rental income, and all the expenses for that property. Everything has to stay within and go out of that same account, but you have to go through the custodian to do all of that. Okay. The custodian, in fact, the custodian actually is the one who takes title to the rental property. And so it's, and then there's fees involved every time you go through that. There's delays and, that sort of thing. So we'll talk more about that here in a sec. Again, talking more about the disadvantages, I mentioned delays already. You have a lack of control because you do have to go through the custodian for everything. Red tape, time, asset evaluation. You have to provide the custodian with an evaluation rather, of all of your assets that are held within the IRA annually. And then, there's fees, issuing a check, purchase sale fee, transaction fees, asset fees, that sort of thing. So those are some of the disadvantages of the custodial IRA, which brings me to a checkbook IRA. Okay, so some people who want to have a little more control over their money, which again, that's our mission, is to help people obtain control of and maintain their, their retirement. And so the checkbook IRA is a product that we offer. We don't do the custodial. But don't misunderstand me. Every IRA has to have a custodian. We just are able to bypass it with the checkbook IRA. It's actually the LLC or the trust that does that. So that's what's created first. It's a special purpose LLC or trust. It's owned simply and solely to be owned by an IRA. It does require IRS compliant setup and an operating agreement. And again, I mentioned you still have to have the custodian per IRS guidelines and law, but you can bypass the custodian when making investment decisions and transactions. So good example. I mean, you can invest in as quickly as you can write a check. So a lot of our clients go to real estate meetups as an example. They investment clubs. And if you've ever been to one of those, usually one of the sections is people pitching their investment opportunities. You do have a lot of wholesalers, that sort of thing. So sometimes though, you come across something and somebody that you really like, and you think that what they're offering is a potential good investment. Well, if you have the custodial IRA, there's time involved. That the window is maybe short in that, and you might miss that window. Okay. But with a checkbook IRA, you can literally just carry your checkbook with you and write a check and invest with that person. So that's the advantage of this. Again, it's for people who want more control and don't want to pay extra fees. So how does the checkbook IRA work? Well, first, you open a new account with an IRS approved custodian. Okay, that's the same thing. Then you start the qualified transfer from the current qualified retirement account, 401k, 403b, IRA, whatever it is. Those two are the same. Then this is the big difference here. Okay, then an LLC or trust is created. Again, it's the special purpose. The single member LLC is formed. Its purpose is only to own, for the IRA to own it. Okay. Then the bank account is opened. Then you can actually fund that LLC or trust. And the IRA, again, it owns 100% of that LLC or that trust. And then again, then you can make investments, right? All the income, expenses, as you see there on the screen, they go into and out of that same account. That's very important with an IRA. Really important, actually. You cannot commingle. If you do, you can potentially disqualify your account, create a big old taxable event and mess, and you just stay away from that. And we'll talk more about prohibited transactions and disqualified parties here in a little bit. So some of the advantages of the checkbook IRA, some of these I mentioned, you can act with speed, you get direct access, you bypass the custodian, you get added protection from the litigation with the LLC. There's low fixed fees. I mean, it's a nominal annual fee to custodial fee to maintain, and compared to the custodial IRA where you have to pay fees pretty much every time you ask them to do something. And then you get to hold the title in the name of the LLC or trust. So that brings me now to the 401k. So what is a solo 401k? Maybe you've heard of it, maybe you haven't. It's actually part of the Internal Revenue Code, Section 401, subsection K, for retirement savings trust. And it's under that section. And it's designed for people who are self-employed or small business owners, hence the word solo. Okay. It's not a new type of plan. It's actually a simple 401k covering the owner and their spouse. And it's made possible as a result of a law called EGTRA. And that came about in 2002. And that law made many of the current benefits of the 401k possible. So before we move on, let's just briefly talk about the benefits of being self-employed. You might think, oh, I'm not self-employed. I have a W-2 job. This doesn't benefit me. But hold on, for a few reasons. One, it might benefit you down the road. It might also, you might also know somebody that you could tell about this. It's always good to help people. It's what we do. We love it. It's one of the bullet points right there in the middle of the screen of being self-employed. You get to help people. And two, or three rather, it's not hard to become self-employed. So and some of the advantages are you're in a lower tax bracket. You get to deduct business expenses first and pay taxes last. In some cases, you can do something once and get paid for it over and over and over again into perpetuity in some cases. And that's also known as residual income. And of course, you can be your own boss, which I can tell you from personal experience can be a blessing and a curse all at the same time. And then if you do things right, you can make more money. And of course, you get deductions. And then oftentimes you can work from home. So has some benefits. So the eligibility. Okay, so I mentioned, it's not hard to become self-employed. And in this economy, it's not. You have the gig economy, and that relates to all these, companies where you're an independent contractor and you can just kind of quote unquote clock in and clock out as you see fit. Think Uber, DoorDash, Uber Eats, those type of companies. What's the other one that people grocery shop for you? Instacart. I actually have people I know at church that a couple that do Instacart regularly, and that's like their full-time job. Well, they're self-employed, so they qualify for a solo 401k. So you have to have the presence of legitimate self-employment activity. Okay, not a hobby, not a photography operation where you spent a couple $1,000 on equipment and maybe you do photos for friends, family, that sort of thing, but you're really not making any money from it. Okay, that's a hobby. And you can actually Google, if you want, IRS definition of hobby. They have a really good article on that if there's some confusion. Some of our clients and some of the other examples are doctors, attorneys, property managers, network marketing, consulting, fix and flippers, wholesalers. Of course, you can sell things online and be an independent contractor. Any income reported on a Schedule C. The other requirement is the absence of full-time employees. Okay, so less than 500 hours a year is a requirement. So if you have a W-2 employee, that works more than 500 hours a year, you're not going to qualify, other than your spouse, which we'll talk more about that. They are exempt from that. And so, but 1099 contractors are okay. All right. And so this is, again, designed for self-employed individuals or small business owners without full-time employees other than their spouse. Leased employees like temp agencies, those are not allowed. Again, less than 500 hours, 1099 is perfectly fine. Virtual assistants out of the country are perfectly fine. And then if they're under 21 years of age, they can work, full time, and that's still okay. But once they hit that 21 mark, you either would have to let them go, or they'd have to work less than 500, or you just pay them on a 1099 instead, if you could do that. So how does the solo 401k work? I like the diagrams. So you have a plan sponsor. Okay, that's your company, that's your business. It can be sole proprietor, corporation, LLC, partnership, and that sponsoring company adopts the plan, and then the trust is created. Okay, this is a special purpose trust with the solo 401k. The trust actually holds the assets of the plan, but you, that little dude in the middle with the tie, are the plan trustee. So you are the fiduciary, you're the trustee, you're in control of all of it. Okay. And then you open up the bank account with any financial institution or brokerage, and then all the money and all the income, again, just like the IRA, goes into and out of that bank account. Okay. I want to talk a little bit about an IRA makeover. So this is Jason. Okay, Jason's out of Tallahassee. He's one of our clients from a little while back. But before he came to us, he had an IRA and a 401k valued at $135,000. He was in the stock market completely and just losing money. And he got tired of it. He actually pulled his money out, and then it wasn't doing anything. So it was just sitting like in a checking account, or maybe a basic savings account, like not making anything, not even keeping up with inflation. So after that, we helped him establish a self-directed plan with checkbook control, and then he went from losing money, not making anything, to making about $1,000 a month on his investments. What he did is he bought a rental property. His brother was an entrepreneur who was kind of a serial entrepreneur, and he invested in his business. Brothers, sisters are not disqualified parties, so that's perfectly fine. And then he actually bought a note. He invested in a real estate note and essentially became a bank. And so he was making money on all that stuff. So that, I just think it helps to put it into perspective what the possibilities are. Obviously, not all results are going to be the same, but this is just one example. And in fact, many of our clients do much better than this from a return standpoint. So what are the benefits of the solo 401k? Well, I didn't talk about this, but I'm going to. The IRA has currently, for 2024, the limit is $7,000 in contributions. Okay. And I probably should have talked about this too earlier. Normally, when people open up a self-directed IRA, I mentioned a rollover occurs. Well, a rollover from a qualified account of 401k, 403b, whatever, doesn't have to occur. But the challenge with the IRA, whether it's checkbook or custodial, it doesn't matter, is the annual contribution limits are so low, 7,000, 8,000. If you're over 50, you have that $1,000 catch up, that it's really hard to do any sort of alternative asset investing when you can only start from zero or very low amount and put in $7,000 or $8,000 a year. So one of the other benefits to the solo 401k, however, is that you can do a rollover and you can put in actually over, with the catch-up contribution, I'll break it down, over $75,000 per year per participant. The reason it says per participant is because your spouse can qualify as well. And we'll talk about that. And then you can double it. Okay. So you have two parts of the contributions. You have the employee side and you have the employer side. And so we're going to break those down here in a minute. But the Proverbs 21:20 says, the wise man saves for the future, but the foolish man spends whatever he gets. And I can certainly attest to that over my years on this earth, that when the money's burning a hole in my pocket and I spend it, oftentimes I regret doing that. So that's something I wish I had adopted in my younger years for sure. So here's the breakdown of the contribution limits. Okay. On the employee elective deferral, think W-2 401k contribution. Okay. This is the same thing on the employee side. So it's up to $23,000 per year. Okay. For this, and if you have a W-2 job, it's the same thing. Plus you get that $7,500 catch up if you're over the age of 50. And on this, you can actually contribute up to 100% of your self-employment earnings. So what that means is, if, let's say I have a full-time W-2 job, it's paying all the bills, and I have my real estate license, and I sell real estate on the nights and weekends. Okay. Maybe I do, I don't know, 3, 4, 5, whatever transactions a year. And it gets me enough to, let's just for simplicity's sake, say that I made $23,000 in commissions in 2024. Well, I could take that entire 23,000, because I don't need it to live on. I have my W-2 job, and I could contribute that entire thing into the solo 401k and not pay any taxes on my commission from real estate. So that's what up to 100% of self-employment earnings means. The contributions must be made within 7 days of paying yourself. Okay. On the employee side, and you can do a pre-tax or after-tax Roth. Okay. The IRA has Roth availability as well, but it's one or the other. With the solo 401k, they all come, and I'll talk more about the Roth, but they all come with a Roth component already built in. So you don't have to have another separate IRA plan and separate deal with the custodian to have it. With the IRA, you do. And so that's, extra fees and everything involved on that, whether it's checkbook or just traditional self-directed IRA. So custodial rather. And then you have the employer side. Okay. We call this is called profit sharing. This is tax deferred. It's up to 25% of the employment compensation if you're incorporated, like an S Corp, and then 20% if you're a single member LLC. Okay. So the simple math on that, if you paid yourself $100,000, you could max out the employee deferral of $23,000 and plus the $7,500. You paid yourself $100,000, you're an S Corp, you can contribute another $25,000 on the employer profit sharing side of things. Okay. You always wait till the end of the year to do that, because you know exactly how much you paid yourself. And you actually have until you file your taxes to make that employer profit sharing contribution. So you can do it all the way up till April 15th, or I think it's October, September. Don't quote me on that, for the extension if you extend. And then the total limit is $69,000 per year for 2024. But actually, if you're over 50, you have that additional $7,500. So it goes up to $76,500. So pretty robust contribution limits. The other thing this has that an IRA doesn't is what's called the participant loan. So somebody, a client actually came to us, and she's a nurse. She had a bunch of high interest credit card debt, revolving credit card debt. And she actually had an IRA, and she was talking to her CPA about taking it out. So the balance of the IRA was $20,000. She owed about 10, and she wanted to just wipe it out. She didn't really care about taxes and penalties on distributing the IRA early. She was willing to do it, but her accountant said, well, you better take out like 15 or a little bit more, because you're probably going to pay about that much in taxes and penalties to do that. Yeah, you'll be debt free, but you're going to have this big tax bill at the end of the year, or at the following year. And so she found us, and we helped her establish a solo 401k. So she was able to borrow the money instead and pay the money off, with her credit card debt off. And she actually was able to just pay herself back instead of pay the IRS the money. And so here it is. So you have the 5-year amortization. This is just simple interest. It's not, it doesn't fluctuate or anything. It's just fixed. 5 years or 15 if you're buying it for using it for a personal residence. Monthly or quarterly, you can make the payments. Prime plus 1%. Last I looked, Prime was 8.5. That was a little bit ago, so double check that. So that would be 9.5%. Literally for any purpose. You can pay off a loan. You can invest with somebody who is disqualified. Oftentimes our clients come to us and say, hey, I want to make this investment with my dad. Well, your dad is a disqualified person, so you can't. But with this participant loan, you can take out up to $50,000 or 50% of the account balance, whichever is less. No taxes, no penalties. Of course, you pay yourself back, and you could make that investment. That would otherwise be prohibited. Essentially, it's a bank that'll never turn you down. I already mentioned it's just not available with an IRA. So let's talk Roth for a minute. This is the real supercharging steroids here of the retirement account. So there's no income restriction. Okay. No income restriction, unlike a regular Roth IRA. The same limit, okay, $23,000 plus $7,500 catch up versus the Roth IRA we talked about, same as the traditional, is $7,000 plus $1,000 if you're over 50. And then, of course, all the income and all the gains are tax-free at the time of retirement, which is fantastic. And you can access, your initial contributions, the seed money, if you will, you can actually access anytime. You already paid taxes on those, so you can take that out anytime. And then you can do a Roth conversion. So this is the decision to make here is, do I want to pay taxes? So a Roth conversion is, let's say you had $100,000 in an IRA. Well, you would take that pre-tax money, that $100,000, and you would convert it into an after-tax account so that all the gains are not taxed, right? Well, that's a taxable event. You're going to pay taxes. In that example, if it's liquid $100,000 cash, you're going to pay taxes on that $100,000 at whatever your income tax is that tax year, right? So definitely talk to a CPA about that before you do it. The question to ask is, do I want to pay taxes on the seed money, or do I want to pay taxes on the harvest, which, if you play your cards right, is going to be a lot bigger, obviously. So that's the advantage of the Roth and the Roth conversion. Again, you have checkbook control. You eliminate the red tapes and delays. There's no custodian fees. You're in control. You get to act quickly. You could do online bill pay, by the way. I mean, you have a checking account. So it's the same checking account you have that you pay your home, internet from, or utility bills or whatever. It's the same type of account, right? It's with somebody who sets it up properly as a solo 401k. And so you could do online bill pay. You can do wire transfers. You can write checks, of course, and you can act quickly doing it, right? The only annual requirement is if you exceed $250,000 in total plan assets, then you just have to fill out a 5500 EZ form, which we help with. It's not complicated. And then that just has to be turned into the IRS with what your starting assets were at the beginning of the year versus what they are at the end of the year. And then purchasing real estate, let's dig into this a little more. So all the incomes and gains are tax deferred. You actually would pay taxes at a future date, of course, with not a Roth account, but with the Roth, they're all tax-free, all the income and gains. And then I mentioned this before, but I'll mention it again. No commingling. All the income, all the expenses must be paid from and put into that account. Using leverage. So this is a distinct difference between the solo 401k and the self-directed IRA. I'll get to that. All of this applies except for the UDFI, which I'll talk to. So all of this applies to both the IRA and the solo 401k. You cannot provide a personal guarantee. The loan must be non-recourse. Okay, non-recourse simply means that the property is the only security for the loan. And the lender, of course, which we have a list of there at the bottom, you can grab that URL and check them out. They all have different plans and different products they offer. And the property has to have a fair amount of cash flow, of course, not a fair amount, but it has to at least cash flow. And again, they all have their different requirements, so talk to them. And you have to have some reserves. Usually it's about 10% of the purchase price of the property in reserves. And then it does require more down, 30 to 50%, which is going to help you get that cash flow by putting more down. And then here's a distinct difference between the IRA and the solo 401k. With the solo 401k, you can get leverage, you can get a loan, a mortgage loan, and not pay any tax on the finance portion of it. So we'll dig more into this, but it will trigger what's called UDFI, unrelated debt finance income, on the IRA, which actually triggers what's called UBIT, which is unrelated business income tax. Now, depending on the dollar amounts, don't misunderstand me. If you're not self-employed and you have no plans to become self-employed, the self-directed IRA, checkbook IRA is a great option, okay? It's just not as good as the solo 401k. And that's the point of this, is comparing the two together. So it still might make sense to buy real estate with financing in your self-directed IRA. You just have to know, and obviously consult your tax professional, that the financed portion of the real estate, if you finance 50% of it, 50% of the income on the real estate after expenses is going to be subject to that UBIT tax. So it scales, it's a scale, and you can go online and look at that, but it scales up to 37%. Okay. So it doesn't start there, but if, depending on the numbers, it can be quite lofty at 37%. So just make sure you know what you're doing on that before you pull the trigger. But that doesn't happen in the solo 401k. There is no UBIT on financed real estate. There can be UBIT, but not on financed real estate. And then the solo 401k plan, I just mentioned that. It's a tax efficient solution, obviously, for leveraged real estate. So you can combine multiple accounts. Okay. You can do traditional SEP, simple 401k, 457, 403b. Usually the 401k and the 457 and those types of plans have to be from a previous employer. Although I did talk to somebody, believe it or not, it's always worth asking the question. This person worked for a big car manufacturer that you all would know if I said the name. And he still worked there, and they would allow him to roll over his 401k, which is super rare, but it's worth asking. So anyhow, and then the only exception is the Roth IRA. You can't roll over the Roth IRA. Don't misunderstand me. If you have a Roth 401k from a former employer that you've rolled over into an IRA, that Roth 401k can be transferred into, and it can remain a Roth account within the solo 401k. So this allows true diversification. Okay, you can invest in just some more examples: Bitcoin. You can become the bank. Real estate, of course. Precious metals. There's some restrictions on that. They don't allow you to invest in all precious metals, and you can't just put it under your mattress or in your safe at home. So, but some people do that. Most people come to us because they want to invest in some way, shape, or form in real estate. Ecclesiastes 11:2 says, "Divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth." And boy, isn't that true. We're here, we're in an election year. Who knows what's going to happen with that? But, I think the last kind of major event we had was COVID. And during that time, it was crazy. And then it got crazier. And, in some good ways and some not so good ways, but, certainly the stock market took a hit. But a lot of our clients, they didn't take as much of a hit because they were diversified into different classes, if you will. So that is that. Okay, let's talk about disallowed investments real quick. So I told you the list is not large, and it's really not. Now this is for the solo 401k collectibles and an S corp, but that's only because you have to be a physical person to be part of an S corp. But again, don't misunderstand me. The S corp absolutely can adopt a solo 401k as the sponsoring company. You just can't use the 401k to invest in S corp. The only addition that's not here that applies as well to the IRA is life insurance. You can't invest in life insurance with IRA. So disqualified person. Think a vertical line, right? Mom, dad, son, daughter, their spouses. Okay, my spouse, right? So those are prohibited, disqualified persons rather. Okay. So it's the lineal descendants. All right. brother, sister is fine. Cousin, aunt, uncle, friend, business associate, that's all okay, all right, to invest with. Some examples of some prohibited transactions are the sale, exchange, or leasing of any property between a plan and a disqualified person. So the best example on that is you own a home personally, and you have a child that's going to go to school rather in the area where that home is. Well, you can't have that child because they're on that disqualified person. They can't live there. Even if they're paying market rent, they can't live there. Okay. That would be leasing rather, between a plan and a disqualified person. Okay. Lending of money or extension of credit between a plan and a disqualified person. So yeah, that applies to investing or loaning money to somebody who's disqualified, but it also applies to you. We talked about the non-recourse loans. You cannot provide a personal guarantee on the loan with the 401k. It has to stand on its own. Furnishing of goods, services, or facilities. So, and then also act by a disqualified person who's a fiduciary, where he deals with the income or assets of the plan in his own interests. So you can't be a real estate agent and represent yourself on a transaction and get paid for it. You just can't do that. You also can't provide services. If you own a rental property, so think the way that our founder Dimitri explains it is really good. Blue collar versus white collar. So if you own a rental property, you can do blue collar work. You can do white collar work. You cannot do blue collar work. You cannot swing a hammer. You can't do anything physical, but you can be behind your computer. You can even manage the property. You can write checks to pay for things. You can go online and find the right plumber or the right handyman or the right roofer, whatever the case may be, and you could pay them. But you can't do the work yourself. You can't swing a hammer. That's like the way that I like to say it. Okay. And then receipt of any consideration for his own personal account, where the fiduciary from any party dealing with the plan in connection with the transaction involving the income or assets. I mentioned the real estate example. Another one is it's the fixer-upper. It's the same thing I just said. If you buy a fixer-upper, you can't do the work. Okay, you can hire people, you can hire contractors and everybody else, but you just can't do the work, because that would be a violation because you're providing services. Yeah, we pretty much covered that. Okay, so here's the skinny of it all. This is a chart, obviously comparing the self-directed IRA versus the IRA LLC versus the solo 401k. So you can take a look and you see some yeses all the way across, and you see some no's mixed in, and that sort of thing. So I just wanted to put this up as a one slide picture for you all to see, the major differences. So there are quite a few, actually. Okay, so that pretty much brings it to an end. I appreciate it. If you want to chat, no pressure at all. But if you want to chat, we're happy to. Sometimes some of the questions I may push back on because they may be a little too intimate to answer here on the call, but that's okay. So I'll refer you back to this, and you can use that URL and book a time on my calendar, and we'll jump on the phone and talk through your specific situation. And then you can contact us directly at that number, or email, of course. But before we part ways, let's go through some questions. Natalie, what questions do we have?
Yeah, we have quite a bit of questions here. A couple people asked if the session is going to be recorded. Yes, the session is recorded, and it will be emailed to everyone who registered. But I've another question here from Ben. When transferring from 401k, is there a way to avoid being taxed and penalized?
Yes. Yeah, that would not be a taxable event to roll over or transfer. So if it's from an IRA, did he say IRA or 401k? Sorry.
From 401k.
Yeah. So if you go from a 401k to an IRA, self-directed or not self-directed, that's not a taxable event. It's also not a taxable event going into a solo 401k if you are eligible for that.
Okay, this question is from Eli. What about partnerships on real estate or syndications? Any thoughts there?
Yeah, you can. I mean, that's definitely okay. You can become, you can invest as a partner in either a syndication or in real estate. Again, you just have to stay away from the disqualified parties, right? The persons. So if it's your dad, that's not going to work that you're partnering with. But if it's not, it's got to be arm's length. Yeah, it's absolutely okay. The one thing I'll say on syndications is just find out how they're going to report the income, because most of them, from my understanding, will report it on a um, what's it called? The I literally just drew a blank. It has the letter K in it. A K1, excuse me. Thank you. They'll report the income on a K1, and that could be subject to that UBIT tax as well. So just watch out for that. And that could potentially occur in a solo 401k or a self-directed IRA.
Okay, question from Edward. If I acquire property with my self-directed IRA using subject to the existing mortgage, am I still subject to UBIT?
Simple answer, but it's got to be non-recourse, which obviously it is because it's sub two. So you're just taking over the payments, and usually the lenders are happy as long as they're still getting paid. So that shouldn't trigger any sort of payoff demands or any sort of events like that. Um, but it could potentially, yes. I mean, it will be subject to UBIT.
This question's from Chris. If you are self-employed and also have a W-2, can you still do this?
Is Chris, is that regarding the solo 401k, or I'm a little unclear on the question. I'm sorry. Maybe
He
repeat
said
it again,
yes.
Natalie. Oh, okay.
Yeah,
Repeat
so
it again.
if you are self-employed and also
Mm,
have a W-2, can you still
mhm.
have a solo
Oh, okay.
401k?
Good question. Yeah. So I should have clarified that in the call, but that's okay. Great question. So you can still do it. However, the contributions on the employee side for the 401k are per person. So if you're maxing out your contribution at your W2 job of 23,000, you're not going to be able to contribute also on the employee side of your self-employed business, right? To the solo 401k. You still can do up to the $69,000 on the profit sharing side, but again, that's 20% or 25% of what you pay yourself for the whole calendar year. So hopefully that makes sense. If you contribute $10,000 in your W2 job, well, you have 13,500 left to contribute into your self-employed 401k, solo 401k on the employee side as well. You just can't go over that maximum 23,000.
Okay, next question is from Michelle. Do the LLCs have to pay state franchise tax?
The LLC, yeah, you have to pay the LLC fee each year. So that's why we do the trust in some states. We're here in California, and we're the most expensive. It's $800 a year. Some other states, it's a nominal fee, so the LLC is okay. But for our California clients, as an example, we usually opt for the trust as opposed to the LLC.
Okay, another question from Chris. Can a self-employed person contribute to a solo 401k and a separate normal Roth at the same time?
Not a problem.
A question here. Can you invest in foreign properties slash assets in the solo 401k?
We have clients that invest in foreign overseas real estate, as an example. Absolutely. Yeah, you're the fiduciary of the solo 401k, so you make the investment decisions. That's the advantage of the checkbook control, is you don't, I mean, obviously you're the fiduciary, so your job is to make safe, smart investments. The safer they are, usually the less return. But when it comes to real estate, just as an example, it's a pretty safe and very good return, right? So just make sure you're crossing your T's and dotting your I's when it comes to any investment you make, especially overseas.
Okay, a question from Michelle. Can you explain how you can contribute self-employment income to a 401k? I have contributed annually. I'm curious about the 7-day rule.
Um, yeah, so you can. Let me just repeat it back and make sure I understand. So, can I contribute annually to on the employee side because I'm worried about the 7-day rule? Is that right?
Just more general, how can you contribute self-employment income? And then she's contributed annually, and she's curious about the 7-day rule.
Yeah, you can, well, it depends on how you're structured, right? If you have payroll set up, you have to do it through payroll, right? So just like you're at a W-2 job, the contribution would come out as a line item on your pay stub. Part of it comes to you, part of it goes to FICA, part of it goes to Social Security, part of it goes to your 401k. It's the same idea. You can also transfer the money directly from your checking account if you pay yourself from you're paying yourself from payroll without that contribution. You still have to do it within 7 days of paying yourself. But if you're doing I stand corrected. I should rephrase that. If you're on payroll, you have to do it through the payroll. But if you're not an S corp, which IRS says you have to pay yourself a reasonable salary, you have to do payroll. If you're just taking money like monthly as a sole proprietor and you don't have payroll set up, you still have to contribute the money within 7 days of paying yourself. So if you paid yourself like on December 31st, essentially you'd have to invest the money on like January 6th at the latest, to do that. So hopefully that answers the question and doesn't confuse you more.
Okay, next question is from Heidi. Is there an age restriction to open a solo 401k?
Um, that's a good question. Nobody's ever asked me that before. I would assume you would have to be 18, but I'll circle back around with you on that question. What's the scenario? Because it definitely wouldn't be, if you were 18 or over, it definitely wouldn't restrict you from doing that. So maybe that answers your question.
Okay, a question here from Vinay. Any profits made to an LLC managing a solo 401k, do they show up in K1 on the individual taxes?
Um, Repeat that again. I'm sorry.
Yeah, of course. Any profits made in a LLC managing a solo 401k, do they show up in K1 on the individual taxes?
No, no. The solo 401k is a totally separate entity from you. Any, all the money, all the investments, everything stays with the solo 401k. If there are any taxes that need to be paid from the solo 401k, they're paid by the solo 401k. It's a totally separate, they have their own EIN number, AKA social security number. So no, it doesn't transfer through to you.
Okay, Gabriella is asking what happens if you don't invest the money within the 7 days?
Um, well, then you wouldn't be able to make the contribution for that in that payroll period. You'd have to wait till the next one. But again, that
Okay.
shouldn't, you can just up your contribution if you missed it, right? It all depends on what you need. It all depends on what you need to live on, of course. But if you missed a $700 contribution this week, you could do $1,400 the following week, as an example.
She did specify that she doesn't have payroll. Is there anything that you want to add to that?
Oh, I think I answered that question the first time around.
Okay, perfect. So looks like those were all of the questions. So thank you everyone for joining us today. If you'd like to speak to Brett about your situation or learn more about Solo 401k, if it's a good fit for you, just please schedule a consultation with him. He'd be happy to help you out, discuss any specifics with you. But once again, thank you for joining, and I hope you all have a wonderful day.
Thank you, everybody. Much appreciated. Have a great day.